Good morning, good evening, and good afternoon, wherever you are. Let's give everyone about 30 seconds to just join in. Right, okay. I think we can get started. And I think I'm really pleased to welcome all of you to Movement Matters, Net Zero Making It Happen. This is the second webinar in a series of 4. We had a very exciting launch of the series yesterday, and we are now moving on to one of the most important topics about finance, and particularly looking at how financing ZEV investments around the world can really get us to achieving this pretty huge, humongous target of net zero, and how people around the world are making it happen. We have Lauren Pamma with us, who's from Green Finance Institute. Prior to joining Green Finance Institute, Lauren was has led a number of finance strategy and commercial roles during her 16 years of her career at Lloyd's Banking Group. She's led electrification agenda for Lex Odoli's, identifying ways to accelerate the transition to electric vehicles. So I'm quite pleased to hand over to Lauren with our eminent speakers on the panel, who she would be engaging with over this session. I welcome you all to ask any questions in the question panel, which will be picked up by our amazing marketing team that is helping us organize all of this. Over to you, Lauren.
Thank you, Sergi, and welcome everyone to today's session. So today we're going to try and answer the question, are our net zero ambitions getting in the way of investments? Does the demand for low risk investments that deliver a commercial return overshadow the need to deliver against net zero goals? And if so, what can be done about it? We're going to discuss and debate the best way to engage private sector investors and operators to meet public policy goals today through the lens of the transport sector. To do that, we'll ask, what is the global emerging experience of bringing zero emission vehicles, or ZEVs, and infrastructure into service? And what does that tell us about future pathways to success? So to help us answer these questions and better understand the challenges that accompany them, I'm really delighted to be joined today by our world-leading, highly experienced panel of speakers from across the financial spectrum. Firstly, Daniel Pulido, Senior Investment Officer in the Global Infrastructure and Natural Resources Department at the IFC, a member of the World Bank Group, and the largest global development institution focused on the private sector in emerging markets. Daniel's the transport sector lead for early stage project development and pre-investment activities. And prior to joining IFC, he worked as a senior infrastructure specialist at the World Bank's global transport practice, where he led the preparation and implementation of loan guarantee and advisory operations focused on promoting private sector participation in the urban mobility, roads and port sectors, primarily in Latin America and Eastern Europe. Before that, he was at Goldman Sachs and some European banks and specialised in the financing of transport and energy infrastructure. And I'm really delighted to have you join us today, Daniel. Next, I'm pleased to introduce Andres Alandia, Senior Investment Officer at PROPARCO, which is part of the French development bank AFD. Previously at the IFC and then BNP Paribas before that, Andres joined PROPARCO in 2019. He's an international structured finance professional with experience in Europe, Latin America and the US, and has built his career around the origination, structuring and execution of debt instruments for impactful projects in developing countries, mostly Latin America and the Caribbean. Andres, welcome to the panel. And finally, from the other side of the table, allow me to introduce Christian Velasco from AMP Capital. Christian is currently the investment director with the infrastructure equity team at AMP, having joined in 2018. He's responsible for the origination, execution and asset management of assets across the Latin American region, as well as providing global coverage in structuring acquisition financing and refinancing for AMP Capital's Global Infrastructure Fund. Christian's led a number of transactions as an advisor and sponsor executive in the infrastructure, real estate, metals and energy sectors globally, and has got a unique view on how the private finance sector evaluates risks within the ZEV sector currently. Christian, thank you for being here. So, long introductions. Just before we get to it, just a reminder, this session is being recorded and a summary will be produced and made available to everyone afterwards. And also, we're really keen to have your questions when we move into the Q&A bit. I've not been made aware of any questions that the panel has said they won't try and answer. So just a reminder of how to ask a question. Just select the question mark icon that's in the toolbar, enter your question in the text box and press enter. Right, that's all the admin out of the way. We'll get into the discussion. So today we're looking at the challenges of mobilising capital for net zero through the lens of the transport sector. Luis Andres, if I can start with you, why are electric urban projects important?
Thank you very much, Lauren. Allow me to share 3 elements which I think are quite relevant to understand. The first one is that urbanization is a growing trend, and particularly in developing countries. So if we take World Bank figures, the urbanization rate was at about 40% in the 2000s and is to reach 60% or even surpass 60% by 2030. Of course, number one, urbanization is a growing trend. A second element is that cities account for 70% of global greenhouse gas emissions as of today. And then a third element is that up to a third of these emissions come from transport. So of course, I think that these figures speak for themselves. If we want to reach carbon neutrality, then of course electric mobility is key within urban transportation projects. Actually, the C40 provides an insightful element as well, is that the rate of public transport use in cities needs to double within the next 20 years. So it's extremely relevant.
Thanks. And from an operator's perspective, one of the biggest barriers to adopting new technologies that can help us get to net zero is that additional capital cost. So, for example, electric buses are almost twice as expensive as conventional buses. How are you trying to overcome that barrier with the projects that you're involved in?
Yeah, indeed. I think it's a very relevant piece of information, because it's not intuitive to understand that the cost of a new bus, for an electric bus, is almost, as you said, twice as expensive as a conventional bus. So, and actually, if you want to have the full picture, you need to factor in the cost of replacement batteries, because again, replacement batteries, you know, the life of the buses usually is about 15 years, but batteries as of today can only last up to 7 years. So actually, if you take the overall life of the bus, you need to have one set of replacement batteries, and batteries cost about a third of the price of a new bus. So if you take the full picture, if you're taking into account these replacement batteries, then approximately you reach 3 times for an electric bus as compared to a conventional one. That's a study actually that we did for one of the projects in which we're investing in Senegal, and the result was that we almost reached 3 times in the price of capex for an electric bus versus the alternative, which was a diesel bus. But of course, this is only one part of the equation. If you only take capex, you're only looking at one part of the full equation. So you need to look at OPEX as well, and the savings that you reach in terms of electric mobility. And savings are notably, of course, related to the cost of fuel. So year after year, when you're talking about electric buses, you are making savings. And that's the full picture that you want to get, not only to take the upfront costs, of course, of investing in these buses, but also all the savings that you're making year after year during the life of these buses. So again, the 15 years that in general we see. And that's where you reach this important concept of total cost of ownership. So if you're an operator, it's not necessarily only a matter of looking at the upfront cost of the bus, which is extremely expensive, yes, but to see how much is it going to cost you throughout the life of the asset to acquire these buses and then operate them during a 15-year period. And of course, I mean, many factors can impact this calculation depending on the country. It can be, of course, the energy matrix, the cost of energy, the cost of fuel. It can be whether you have tax incentives for electric mobility, and so on and so forth. So the calculation, of course, is not one that, standard that will apply to any country, but it gives you a broad idea. If you compare this total cost of ownership of an electric bus versus a conventional solution, and then in some countries, of course, the gap is going to be wider. And then it may justify, from a lender's perspective, the use of investment gap subsidies. And you see many donors that are looking at projects, from this angle, and you can actually try to compensate that gap with investment gap subsidies, which is something we're doing in a project in Senegal, for instance.
Great. I think we'll come back to that a bit later on. Christian, if I can just turn to you, what's the appetite of private sector to invest in net zero transport solutions, and in particular, I guess, as well into the supporting infrastructure?
Thank you. So as a general theme, evidently investing into decarbonization of transport is highly attractive for institutional investors globally. Evidently now, with the shift in classifications of GPs and funds that are very relevant as it relates to ESG credentials, that's also something that's driving quite significant amount of appetite from institutional investors globally as well. So all in all, it's a really interesting sector. I think obviously the devil's in the detail, and when you talk about supporting infrastructure in decarbonization of transport, there's various limbs to that. You can look at decarbonization of fleets, and you can look at what many of the platforms in EV charging are doing, for example, in Europe, and rolling out EV charging throughout for regular vehicles for individuals. And so that both of those types of investments have very different risk profiles and different types of capital that's being allocated to that. I think as it relates to kind of how we see it as infrastructure investors is that deployment of the capital in EV charging, for example, which is support infrastructure in the EV space, is quite a challenging one as an infrastructure theme, particularly given the unknowns around driver behavior going forward, and how that's going to play out in terms of where people are going to end up charging their vehicles as battery technology changes over time. So we have to figure that out. But I think there's also an element of quite a significant amount of merchant risk in that. So I think that'll have its own, capital allocation, which may be, at a higher cost at this stage. And then there's obviously the fleet side of things, which is a lot more, I think, doable, and why you see a lot of institutional infrastructure investors, coming into that space now, because that is very much, long-term contracts, predictable routes. EV charging that is going to be utilized based on specific fleets that's being used exclusively, whether that's investing into the fleet and the EV charging, or whether that's as well into the energy provision and energy management services. Ultimately, there's a fleet on the other side of it that's going to be utilizing it predictably. So that's something that evidently that has its challenges as well, but that is where I think, over the next couple of years, infrastructure, particularly low cost of capital in the GP space in terms of equity, is going to be coming in. So I think that kind of summarizes in terms of investor appetite.
Yeah, so it sounds like the capital is there and there's appetite, but there's just some barriers to actually mobilizing that investment. One of which sounds like data and certainty about future revenues, perhaps because of lack of data that backs that up and backs up some of those predictions.
Yeah, I think in respect of those two business models, when you look at fleets, the key component there is finding opportunities of scale and entry points of scale, which has been very challenging in the market. So that's a particular focus, because evidently, teams of institutional investors are small enough that we can't, allocate human resources in looking into opportunities that aren't of sufficient scale that we can meaningfully deploy capital into those. So that's one. And then I think the second is obviously structural. So rolling out those, opportunities at a scale, but based on a bankable structure. And we've seen a number of processes, tenders that have come out which have had challenges and have had to have, players coming into the transactions that would generally not be the most appropriate ones, like OEMs that really don't want to be a long-term investor into this space. They actually, not the lowest cost of capital either. So, I think where you'll see is, structure needs to be enhanced, and that's something that's kind of working through its way through multiple municipalities across, different geographies. But it's something that's happening a little bit more on a contagion basis and learning through, the mistakes of other jurisdictions. And, institutions like the IFC, the World Bank have been instrumental in kind of teaching some of those learnings from, other jurisdictions into, implementing those in new, places. So that's been quite interesting how that's played out. And in terms of, looking at the more merchant piece of, EV charging and infrastructure more broadly, I think there, as I mentioned, key components of understanding that is going to be related to driver behavior and technology. Again, I think that's a different pool of capital that'll be allocated into that, and somewhere where, obviously it'll need quite significant amount of government support to be able to stabilize that market and roll it out at a cost-efficient manner.
Well, that's a lovely segue to move on to Daniel. So obviously Christian there's just talked about some of there's appetite from private sector, but there's some barriers as well. Besides those sort of specific technical and financial issues that make financing e-vehicles challenging, what are the other barriers that need to be overcome to mobilise private investment to reach our decarbonisation goals? And what can organisations such as the IFC do to crowd in private capital?
Sure. I think we've heard from Luis and from Christian about all of these challenges that we face when evaluating investments in electric mobility, for instance, and they refer to the higher costs, to the technology risks, as well as the issue of scale, right? That we haven't reached sufficient scale in some of these investments. However, in addition to this, I think we first have to look at the basics of any private investment in infrastructure or in transportation. And I think when talking about emerging markets, there are many of these fundamental issues that are still present that, they would apply in the same way to the transportation, to the financing of conventional transportation as they apply to the financing of electric mobility. It's just that when you talk about something that is riskier and more complex, their importance is even more is even more significant, right? So that is why at IFC we're focusing on a lot of these early stage project development activities and pre-investment activities that aim at closing any market gaps and removing any barriers that you have in the fundamentals, so that then you can have DFIs and commercial institutions and investors come in and finance these projects. And I think, if I can enumerate a few of these, I think the most important is the institutional aspects, right? You have countries where they have developed a legal and regulatory framework that has enabled an uptick in investment. You have, India, you have, from the developing world, right? India, of course, in the developed world, Europe and the US. But in many of the countries where we operate, those enabling regulations are still lacking. So starting just with the basics of having an electric mobility plan for the country, and then having some economic and non-economic incentives to drive the scale. So that's why we have been focusing on that in Egypt, for instance, where we're working with a private operator of charging infrastructure to identify what are some of those key regulatory changes that need to happen, and presenting those to the government as a way to drive the adoption of electric vehicles and make a charging business sustainable, which in turn is key to continue to drive electrification. We have also done it in places such as Brazil, where you already have, you have the issue of having very low fiscal capacity at the subnational level, meaning that subnationals cannot really go out and finance e-buses on their own balance sheet, but at the same time having already existing concessions that have like 25-year terms that are not compatible with introducing more expensive buses. So just working with them and presenting to them different, business to business contracts or fleet supply PPP that they can use to roll out electric buses, while at the same time keeping their existing concessions. And in other places, it's just about fine tuning. Like in India, we work with the support of STEER actually in coming up with what additional regulatory changes having to do with taxation, having to do with the registration of vehicles, as having to do with financing could, continue to drive electrification. So that's one. I think institutions are key and regulations are key. But also, I think the fundamental bankability aspects of contracts, right? So you can have all of the will of the government to drive electrification. You can have interested investors, but if the contracts still have issues, then you're going to have a higher cost of capital. You're going to have less bidders interested in the project. So I think one very good example was what we did in India, where we identified many changes to the master concession agreement that they have for electric bus operations. That's a gross cost contract that is very popular in India, and that was the basis for the deployment of the FAME2 subsidies. We identified some basic changes, like for instance, clarifying termination provisions, capping penalties so that investors will have certainty about the cash flows coming into the project, making sure that the definition of force majeure included things such as the lockdowns that were very prevalent during COVID, increasing security of payment, making sure that any bus supplier or operator would have certainty that they would get paid. So all of those things were actually introduced by the transport undertaking of Mumbai, and they were able to achieve significant cost savings of around 35% in their contract. And then that was later also rolled into the wider nationwide procurement as part of the Grand Challenge. So that's another aspect of the basics that we need to solve in order to drive international investment in scale. And then I think the last one is basically you need to have, in order to have investments, private investments, you need to have a government that is able to put together those investments and that knows what to do. And I think that's kind of like the third pillar of the work that we have been doing as part of our pre-investment activities, is to work with cities in defining what is the best technology that is, for the specific characteristics of the city. Should they go with trolley buses? Should they go with battery electric buses? What routes are the most suitable for electrification? And we have done that actually in a few places, particularly in Eastern Europe. In one of those projects, we were supported by STEER. So I think, it is important to, and we also developed an e-bus toolkit that is actually a tool that cities can use to figure out what is the best electrification option. So I think, in addition to the specific transactional aspects, once you get a deal in front of you, you need to work early in the project development cycle in solving some of these issues so that you have better investments that deliver an adequate risk-adjusted return.
And do you think organisations such as C40 Cities have a role to play in some of that as well, in terms of engaging with governments and municipalities to try and put the plans in place and help them develop transport strategies, so they're not just doing it in isolation?
Yes, actually, we have been working very closely with them, and we have a partnership also in Latin America, and where we have jointly supported some of these efforts by some of the Latin American cities. So definitely there is a role to play. I think what makes us unique, as I think Christian was referring to, that is that we're trying to transfer some of the best practices that we're seeing in certain regions, such as Latin America, where you're having the most significant deployment of e-buses outside of China, and looking at what's happening there and what are the key factors for success there, and trying to sell those same models to other countries that are experiencing the same challenges. So I think as a global institution, that's an important role that we can play, bringing the experience from elsewhere to countries that are, just starting to think about this.
Yeah, it's that sharing of best practice, isn't it? So that people aren't starting again from scratch each time they look to do a transport project. Thanks. Look, Luis Andres, just coming back to you briefly before we start to move on to solutions. What other specific issues did you come across when looking at structuring the financing of e-buses?
Well, I think that Daniel mentioned quite a few. Then you always have to face the sort of typical challenges in urban transportation. If you have traffic risk, then how are you going to mitigate the traffic risk? That's one, of course. The local currency aspect is another one, because, well, of course, the revenues that you're going to have are in local currency, and then as an international lender, you do not necessarily have a direct access to local currency. So how are you going to structure that? But I think that applies in general to all urban transport projects. What I think is quite interesting in terms of electric buses, and we've seen different things in the, we've had the opportunity to close 2 financings so far, and we're working on closing the 3rd one. And it's been, different experiences when it came to the financing of replacement batteries. I mentioned replacement batteries before. It's, it's quite relevant because, again, it's up to 1/3 of your capex that's coming in at year 7. And of course, that, as a lender, you don't want to leave that loose and find yourself in a situation where eventually, the project does not have enough funds at year 7, and then you have buses that have a life and are expected to operate for 15 years and that cannot continue to operate because they don't have the replacement batteries. So of course, the first thing there is what is going to be the approach towards securing the supply of those replacement batteries. And the approach can differ because, and it's a matter of risk aversion as well. You're going to see some players saying technology in electric vehicles has been evolving so fast that, trying to secure something now for 7 years from now, it doesn't make any sense. I mean, you're losing a big upside in terms of, what are you going to be able to get in 7 years from now, in terms of, a better performance of batteries for perhaps half of the price of what an option would cost you now. But that's one perspective. Then you can also see the issue from another angle and say, with scarcity of resources, maybe 7 years down the road, if there's such a big explosion of e-vehicles, the supply of batteries might be something extremely challenging, or so perhaps you want to have a different approach, more cautious, and try to secure that. So that's one thing. What is going to be your approach towards securing the supply of the batteries? And then comes the matter of how are you going to finance this? Because again, as a lender, you don't want to have that risk of having such a big investment to be made on year 7. And what we have seen so far is really different approaches. On the first project that we financed, this was in Colombia with Electribus. It was the first fleet of electric buses for the SITP, which is the urban transport system in Bogota. And actually, the approach was very cautious. They said, we want to secure the supply of batteries in year 7. So basically, a contract was passed with the bus supplier to secure the supply of those batteries in year 7. And as to the financing, what we did is just extend financing that was committed from day 1, and which is going to be disbursed in year 7. So from a financial perspective, it's not the most complex structure, nor the most efficient one, but it was, a safe bet that we were all comfortable in taking back then. The second project that we financed, and this was Green Mobile, also in Colombia, and with big operators behind, ZEV being one, and Fanalca, the local one. And what they decided to do was a different approach. They said, bus suppliers and battery suppliers are more and more seeing that there's this, big issue of replacement batteries, and what they want to do now is try to sell you the batteries up front with a heavy discount, so you can choose to basically prepay the batteries and include that cost as your initial capex and project costs. So that's what we did. Basically that was included in the project costs, and we basically dispersed that upfront. And then a third experience that we saw, and this is in Senegal. It's going to be the first electric BRT in Africa, so it's a landmark project, and the approach is being a bit different. So they're securing the supply of batteries through an option. They do not necessarily, sponsors are not necessarily looking into financing this as of now, but through a reserve account, basically, where you are going to have funds, accumulating during the first 7 years, with an equity support, of course, if there's a mismatch, and that's going to give you the funds necessary to pay for those replacement batteries. So I think that's that's an interesting topic. I hope the answer was not too long, but we can come back if you have any questions on that.
No, that's great. Thank you. There's a lot to unpick. I've just been asked to remind people how to ask a question. So if you want to ask a question, you're in the audience, please just go to the control panel that's at the top of your screen, select the question mark icon in the toolbar, enter your question in the text box, and then press enter. And we have had some questions start to come in already, which is great. And I've got one for Christian, actually. So with the electric vehicle investment being seen as an attractive option for investors, how are investors assessing the short-term risks on mineral prices and US-China geopolitics impacting the supply chain for EV manufacturers?
Hi, Lauren. Is that one for me? Sorry.
It is for you. Sorry. Yes, I did. Yeah.
Okay. Okay. No. It's a very good question. I think in practice, the way we invest into fleets is evidently a result of the existing conditions. And so, for example, battery prices I think ticked up this year, as Luis was mentioning. There was an uptick on prices of batteries this year, just given shortages on kind of movements on commodities, etc. So that was a phenomenon that we hadn't seen over the last 6-7 years, where battery prices had come down quite materially, and everyone was baking in further reductions in battery prices. And when you're looking forward, I think the way we've actually gotten very comfortable is we actually don't underwrite any residual value into the batteries. And so I think where perhaps a more aggressive investor may actually look at, well, there's a residual value of, I don't know, 30, 20, 10% of the curve in 7 or 8 years time. Then at that point in time, well, obviously you're assuming a price movement throughout time, and if there are variations as it relates to that price, given geopolitical factors or anything, whether that's idiosyncratic or not, at the point in any point in time, but that ultimately affects how that residual price is, residual value plays into your own investment case. Just given we don't actually take that risk, what we look at is, well, what is our cost today? If we want to go out and buy a substantial amount of kit, which effectively is EV charging kit plus buses plus batteries, and we will underwrite that for 15 years. And as Luis was mentioning, well, just given the scale of the business, we can negotiate substantial discounts just because of scale. And in that sense, we actually don't have to take on any residual value risk. That's something that we may change, and I think as as this business model progresses and people get more comfortable on stabilization of prices of materials and stabilization of technology, then people will start, and obviously creation of secondary markets, which we haven't really seen very large amount of fleets, for example, EV fleets, whether they're buses, trucks, or vehicles, come out to market, and a secondary market exists for you to take on chassis risk, on end of life chassis risk, for residual value or second life battery use, whether that's actually, achievable, because it's very, dependent on a specific market, right? So it ultimately depends on what you're underwriting on your investment case. But as those markets start stabilizing, you can actually start building those in and start integrating those into your business case. Obviously, at this stage, where, as you well mentioned, a lot of those prices are highly volatile because they're, there's kind of two conflicting, kind of trends. One is technology is moving very quickly still, and two, there's still volatility that relates to the actual underlying, commodities that compose these kits. Then, you end up having to make an investment case. Is really difficult to do with so much volatility. So, I think we take all of that aside and just think about it. Okay, we don't take on that risk now, but as I mentioned, we may do in the future.
Right, thanks for that. And then you touched on sort of higher risks and potentially higher rewards. Daniel, if I can just come back to you, given that decarbonisation needs sort of significant investment, that perhaps that, the returns aren't necessarily there yet, but the risks are higher, the risk and reward profiles don't always match up. How can we provide incentives for investors to deliver against net zero goals? And
Sure. I think that a big incentive is being provided right now by the growing size of the sustainable finance market, and the fact that the sustainable finance market may just become the finance market, right? Like all of financing will in the future become sustainable. And what that means is that, there is growing interest from investors to put their money in sustainable finance products. Like 90% of investors in the US have expressed interest in this type of products. The use of, or the flows into sustainable ETFs has increased, I think, by 10 times in the last 3 years. So definitely there's a lot of interest on the investor side. And not only on the label products, like the traditional green loan that is based on use of proceeds on the money going into e-buses or electric, mobility, but rather in financing instruments that are linked to outcomes. So whether, those investments can actually trigger a reduction in GHG emissions, and whether that, reduction is ambitious enough. So that is what is happening right now with the sustainability linked bonds and loans, which is a market that is growing tremendously, and it's a market where IFC is trying to play a role by enabling more issuers in the developing world to access that market, because initially has been mostly dominated by European and US issuers, mostly in the electric power sector, not so much in transportation. So we're working with some of our clients to help them get there, and I think the first step is for them to develop a sustainability strategy. I mean, what is really their ambition in terms of reducing emissions and achieving like net zero operations. And from that, you build kind of like your targets based on where your competitors and based on where the industry stands, based on what is technically feasible, and state those targets and like put your money where your mouth is by linking the achievement of those targets to your cost of finance. So I think that's what we're doing right now. We're doing that with a ports and logistics operator in India, which is one of the largest in the region, and we're working with them to develop that sustainability framework and targets that will allow them to then issue the sustainability linked bond or loan to invest in, in electric port handling equipment and trucks to decarbonize their operations. That is kind of similar to what other port in Turkey did in 2021, Limak Port. I don't know if you're familiar with that deal, but basically that was a sustainability linked bond where the company committed itself to getting a certain percentage of their trucks and forklifts to be electric by 2030. So, and that if they are able to meet the goal, they keep their margin. If they don't get to that goal, their margin goes up. So I think that is the best incentive that you can have. We cannot think about it only in terms of money. It's not that investors will just go for those products or for those financing solutions just because they're making a calculation in their head that they will save some basis points. It goes beyond that. It helps them, access that market, which would give them the ability to reach a wider set of investors that they could otherwise do. But also, really reinforce their commitment to sustainability, which is really important for their customers. So if you're a logistics company, you may start facing growing demands from your customers to decarbonize your operations so that in turn they can reduce their scope 3 emissions and sell to their customers that they're like a more responsible company. So we're seeing that transformation, and we're trying to get more companies to access the sustainable finance market, which I think will be kind of like a very important incentive to drive investment into net zero solutions.
Yeah, I think you're right. It's definitely been going that way, hasn't it? We've had a question come in actually, which probably builds on that. Do we think that the appetite for private financing of electrification is reducing at the moment due to the rising cost of capital? So, what are we seeing anyone saying actually, with the movement, money going the way it is sustainability still the priority, or are people actually going, we can't afford to do this right now? Interested, I guess, in your view and in Christian's.
Is that for Christian, or should I start?
No, both of you. Go on, Daniel. Please go first.
Okay. No, I think certainly. The cost of finance is going up, which I think gives DFIs as IFC and PROPARCO kind of like a more relevant role in this transition, because the way that we're funded, we're able to offer longer term and in some cases better price financing for markets that are perceived as being riskier. So definitely that is increasing the role that we can have in this transition. But I think, overall, as I said, it's not a question of cost anymore. It's not a question about the cost of finance. It is a question about making your company attractive in the eyes of customers and being able to, operate, having a license to operate. So investing in a zero solution goes beyond, just pure calculation at the transaction level. That would be my take on this.
Christian, any differing view, or are you broadly aligned with that?
Sorry, you cut out a little bit, Brian.
So the question we had in from the audience was, given sort of rising cost of capital, are you seeing a reduction in the appetite for private finance of electrification?
Not really, because I guess it is, interest rates are rising evidently, and that's driving cost of debt higher. But at the same time, at least on the electrification of fleets from municipalities rolling out mass transportation, on that side of things, most contracts will be inflation linked, and so inflation ultimately will offset the incremental interest rate environment, so the high interest rate environment. So in that sense, it's actually quite resilient asset for these types of macroeconomic context. So it's a, which is another feature of why we actually are quite interested in this asset, and why you'll see infrastructure investors quite interested in further deploying in this. I think that's in fact probably kind of the most interesting feature, just given the current macro context globally.
Okay, that's good, thanks. A question for Luis Andres. You mentioned that the normal urban transport investment risks, like traffic risks, remain with EV investments as well. How are you seeing the sort of broader push-pull mechanisms play out across different parts of the world? For example, bans on ICE vehicles, charging users to enter low emission zones, subsidizing green public transport, etc.
Yes, indeed, Lauren. And we've, again, I mean, it depends on the geography, and we've seen different things. Something that I think is making a lot of sense and is helping to contribute to this success of electric mobility in Latin America that Daniel was mentioning in terms of rollout of electric buses is this sort of new concession model that has been used in Chile and in Colombia as well, where basically, as opposed to a traditional, operation model where you have a single concession, which is going to have the responsibility of acquiring the fleet of buses and then operating these buses, you're going to separate this into two. You're splitting it into two different concessions. So one concession is going to take care of the asset acquisition, and basically that's it. So it's going to be the buses and the charging infra, and the responsibility is only to acquire these assets and being able to, deploy them for the system for 15 years. And then you have another concession, which is going to have no responsibility whatsoever in terms of capex. They're just given the buses to operate, and then they're going to operate the buses for 15 years. And where it becomes really interesting is that it makes a lot of sense when you start thinking that, it really is a matter of, what skills do you need to be in each side? If you're an operator, then does it really make sense? I mean, what you need to do as an operator is basically have the local experience and know how to operate the buses. Does it make sense to put you the burden of, having to acquire the buses, having the equity to do so, having the capabilities to structure the financing, and find the best financing solutions in the market? Perhaps remains to be seen, and it has been something that, has proven to be quite difficult, for instance, in Bogota in the early years of their concession model. So in this case, of course, you have the operator who only operates the buses, and then on the other side, you have investors, such as Christian, for instance, who have, of course, all the capability in terms of bringing in the equity, structuring, the most competitive financing solution for the buses, and then they have a different profile. They're not operators, they're investors, and then what they're doing is then, just perceiving a sort of availability-based payment scheme throughout the life of the concession. So I think that this, again, split of concessions and this unbundled model where you have asset acquisition on the one hand and the operation on the other has been extremely successful in Santiago, in Bogota. Is making a lot of sense and is helping to roll out, electric buses in quite a sizable way.
Great, thanks. Another question's come in. So for electric vehicles to really push the scale on emissions, the energy source behind it has obviously got to be clean as well. How's the financing panorama for transitioning to cleaner energy sources? Is that also being considered alongside the transition to electric vehicles? Is that something you consider when you're considering investing in these vehicles? I guess it's the question, how clean is it really? And what's the infrastructure look like that sits behind it? I'm not sure who wants to take that question, but
I mean, I can provide a couple of elements on how we see it at PROPARCO, at least. Of course, the energy matrix is key. I mean, and it's true that intuitively we can think, electric buses are good, but then of course it depends. If you roll out as of today electric buses in India or in Poland, for example, and you compare the emissions with gas units, for instance, with gas buses, then no, in terms of emissions, actually, an electric bus is going to, cause higher emissions. But then I think that two elements need to be taken into account. The first one is that, of course, when you invest in these projects, as we were saying, the buses are going to last for 15 years. So the way we see it internally is that inevitably energy matrices are going to go greener. So it makes sense still, even where you have, an energy matrix that is still not as clean as you would want it to be as of today, it still makes sense, you know, to deploy and to push for this deployment of electric buses. That's one. And then the second one is also that I mean, it's of course it's of utmost importance to think about emissions, CO2 emissions, but you also need to take into account the other air pollutants in conventional diesel buses or gas buses, and particularly in developing countries. I mean, when you see cities and the pollution in cities such as I don't know, Mexico, Bogota, and so on and so forth. I mean, of course, that there's also a big impact for, you know, the health of the local population, whether you're considering diesel or gas buses versus, e-buses. So it's also a second element to be taken into account, you know, besides CO2 emissions.
Great, thank you. Any other points from anyone else on that point? If not, I've got one last question to ask each of you before we wrap up.
I think Luis summarized very well. I think another aspect that I have seen has become a very important consideration as well is battery recycle and reuse as a key component of how we look at these investments holistically. So if you can have, you know, manufacturers that can factor in those aspects into their offers, that will make it, you know, more compelling in terms of looking at the overall impact of these investments.
So I know it's my job to sum up in a minute. I'm going to pass that job over to each of you three. In a sort of 30 seconds, could you sum up your thoughts about what's the one thing that you'd like people on this webinar today to take away and do differently as a result of what they've heard today? Christian, I'm going to come to you first, if that's all right.
Sorry, is that what? Can you repeat that? Apologies.
What's the one thing you'd like people to take away from today? The sort of one message you'd like to go out there from this webinar?
I think that the key message is that decarbonization of transport is a very interesting space for investing, financing, and really we need to see a further push by municipalities in driving decarbonizing, for example, mass transportation. We've seen a little bit of that across Latin America mostly, some of it coming through Europe, but there's other jurisdictions. India is doing quite a lot in that space as well. There's other jurisdictions that really need to move quite quicker in that regard, but I think it's a quite an interesting opportunity, and really to Luis's point previously, where he mentioned something around the TCOs and comparing that to diesel. Scale is everything in this space, and people need to really understand the benefits of cost that are driven by scale, and all of the relevant benchmarks that you look at in white papers, written by any expert currently, will all be driven off of, mostly off of kind of off-the-shelf retail prices. And so the TCOs really are not reflective of the benefits of scale. And when you actually build in those benefits, in reality, an electric bus is actually, much more competitive than a diesel, or a traditional energy bus currently. So that's something that I think is not, I feel is not really come through the market, or they haven't really been able to appreciate that.
Great, thanks. Daniel, what's the one message you'd like people to leave with today?
I think an important message is that we also need to focus on funding in addition to financing. We've been talking mostly about financing in this session, but somebody needs to pay for that financing. And usually in urban transport operations, you don't pay back capital investments via user fares, right? User fares rarely cover operational costs, let alone the cost of renewing a fleet. So it's important to come up with additional sources of funding at the subnational municipal level to pay for this electrification. That may imply, parking charges, congestion charging, higher taxes on private vehicles. You need to think creatively about coming up with the money that you will need to drive, electrification. You have private investors who are willing to, put the money up front, but you need to pay that back, and you need to pay that back at a reasonable rate. And you can only do that having certainty of payment. And then the other thought really quickly is about the importance of thinking outside the box. I mean, traditionally, when you think about project finance for buses, since we have talked mostly about buses, so let's keep it focused on buses, you think about these GCC contracts, right? But the history of these GCC contracts in terms of private finance is not the best. So in order to drive up scale, as Christian was saying, which is key, and also to allocate the risk with the party that is better able to handle them, as Luis was saying, we think that these, aggregator models and, unbundling of supply of buses and operations is really key.
Great, thank you. And Luis Andres, final 30 seconds, if that's all right. Anything you'd like people to take away?
Yes, sure. And I'm lucky enough that Christian and Daniel mentioned other ideas than the ones I had in mind. But,
okay, that's great. Well, go on, sorry.
To me, I think, so going back to what we said in the introduction, I think that, electric vehicles are key. Electric mobility is key to reach carbon neutrality. So we cannot, I mean, it will continue developing. That's a fact. But it's not a magical solution either. And I think that's where it's also very important to gather and to think outside of the box. Daniel mentioned it, because of course, energy matrix, yes, I mean, we cannot greenwash everything and just say, EVs are the solution to everything. We have to think of energy matrices and how these are going to go greener. We have to think about sustainable mining as well, of course, because of lithium and, many other components. And so again, it's not a magical solution, but it's, I mean, it's crucial in terms of carbon neutrality as of today. And the last one, if I may, is also that, this has been developing so fast again that we're, I mean, many actors say that we're all sort of taking a leap of faith. Technology has been evolving so rapidly. This, as of today, of course, you mentioned at some point, China, the market is completely Chinese. You have new suppliers going into and this is growing at such a fast pace. We don't have the track record to see, what solutions have proven to be efficient and not. And that's also very, very important aspect too.
That's great, thank you. So I'm really sorry to say we've come to the end of our time today. I'd just like to thank Daniel, Christian and Luis Andres and you, our audience, for sparing your time to share your insights and views in what I found a very thought-provoking and insightful discussion. A number of things resonated with me today. There's clearly appetite across the private sector to invest in net zero, but there's a number of barriers that's stopping that money moving as quick as it needs to if we're going to meet our net zero goals. One of those challenges is a lack of scalable and bankable projects, and there's a role that development banks can play to get those projects to that bankable stage. And I think crucially, public and private sector collaboration is going to be really critical in mobilising the sums of capital that we need to get us to net zero between now and 2030. So thank you all again for attending today, and I hope you enjoy the remaining webinars. They're showed up now on the slide, and I'd just like to finally wrap up by handing over to Sergey to close off.
Thank you, Lauren. On the dot with 30 seconds to spare, you've made my job so much easier. Again, it was captivating. It's very rarely we get opportunity to hear from such wide-ranging experiences, from a private investor to a market creator to somebody who's been there, done that, and has lots of interesting solutions. I think we are all learning through this process, and that's probably the biggest takeaway for myself. And it's really great, Lauren, how you've sort of tied it all together. So thank you for hosting this webinar for us. Again, lots of interesting questions that came through. Some of them were answered, some of them weren't. We will be wrapping it up through a small summary note that will go out, and please come and attend some of the other webinars we've got going on communities tomorrow, and wrapping up with adoption day after. This is Sarvjit Kohli, sustainability lead at Steer, signing off and saying thank you to our speakers and our host. Thank you everyone for attending.